Thanks for joining today. Just to do some quick intros, and I'll give an overview of the structure of the session. So I'm Steve. I head up the high growth team here at Cooper Parry. I'm actually an audit partner by discipline, so I see a lot of these points coming up across our audit portfolio of companies going through funding rounds and exit events. And I'm just going to run a conversation session today with Simon and James, who look after a lot of businesses coming through diligence events. And we're going to structure the session around kind of two kind of main sections, one being that kind of scaling phase around Series B plus, and then the second more around exit readiness in the exit transaction, and what some of the areas are to consider when you're into an exit timeline. So I'll let James do an intro first, then we'll go into Simon, and then I'll kick off the session with questions.
Hi everyone. So I'm James, head of tax for the tech and high growth team. Background is very focused on kind of M&A transactions, being in diligence by trade, and then bringing that learning and knowledge of all the deals that I've worked on and some of the stories that I'm going to share today into real life kind of situations for clients as they gear up for either later fundraisers or some kind of liquidity event. So yeah, I'll share some of the war stories I've seen over the years. Hopefully how we fix some of those as well. You can't always fix everything, but you can have a good stab at it. Simon?
Thanks, James. Yes, hi everyone. My name is Simon Nichols. I'm a partner in our Cooper Parry deals team, focusing on transaction services side of things. So done an awful lot around the sort of slightly later stage when you've got an exit plan, exit readiness, vendor assist and vendor due diligence, and we'll explore a bit more about the difference between those two as we go through the conversation. And again, similar to James, trying to bring some real practical life examples of the things we've seen on deals, the things that make a deal work really well, and equally the sort of pitfalls to avoid both before and during a deal.
Cool. Thanks, guys. We do have the Q&A on. So if you want to drop questions in, I'll be monitoring the Q&A and I can weave the questions in as we go through, or I'll move them to the end if they don't quite sit in the structure, but drop questions in as we go. So just coming to that kind of first section to give us some signposting around the scaling phase. Let's say Series B plus, assuming that kind of pre-Series B diligence is relatively lightweight, and let's really dig into some of those sort of areas of consideration around Series B plus diligence. So yeah, coming to James first, just give us your perspective on how almost put yourself in the shoes of a CFO. How would you approach managing diligence risk through that scaling phase?
Yeah, I think putting myself in the shoes of a CFO, right? I think it's something all around like having a proactive tax agenda. Okay, so you said it earlier, and I'm just going to cover this point at high speed, but you don't really get under the skin of any diligence really until you get to Series B, right? Series A is very light touch. It's unlikely to unearth anything. And if we start looking across the board about when other kind of tax issues are going to be raised, it is unlikely that they're going to be raised from HMRC unless there is a very specific inquiry. It's also relatively unlikely that the auditors will pick up on it. And therefore, it's incumbent on the CFO that they have an idea of some of those risks, right? And the time it really starts to kick in is at Series B. And that's all to do with kind of the disbursement of funds that, say, an investor will use at that point. So it is heavier. It will be a lot more detailed. So once you're through or gearing up for Series B or B plus, I think the main area to concentrate is really understanding where the risks in the business lie, because they will come and they will bite you at a later stage. So as a CFO, what I want is an acute awareness of all those issues, how relevant they are. So are they actually going to be deal breakers? Are they kind of like mid-level risks that are going to be just kind of indemnities and warranties? And also tax people love a theoretical risk, right? So how do I balance those? How do I understand what's going on in the wider business and make sure that I've got a clear idea of planning for the future, aligning those to the growth plans of the wider business as well? What do I see as main areas? I think we're going to touch on some of these with some real life examples, but internationalization post Series B, given the funding that's been received, creates a lot of tension. It creates opportunities as well, but we see a lot of shortfalls coming as you scale operations internationally. And international also can mean that given the kind of post-pandemic world, the world has moved on a little bit. So we hire people on more of a global footprint, and that creates tax risks. Or we allow our workforce to work more remotely. And again, these things can lean in, and I'll give some examples later on. So yeah, mainly around, I would say, being proactive, coming up with a tax agenda, understanding where the risks lie, and to start to think about creating the relevant documentation, and creating what I'd refer to as kind of data room ready, right? So be ready and create documentation that you can then present, so you're not scrambling around at the last minute trying to find things, or inadvertently identifying issues too late in the day. And that is an issue, right? We see that all the time, either at fundraise or at liquidity events, where people haven't identified issues, and then you're 2-3 weeks out or a month out from the transaction. How do you deal with those? And some of them can't be dealt with, right? So take your time, plan, speak to someone that understands the diligence process, and who can help you proactively make decisions in advance, so you can then run into that process and it should be really smooth at that point.
In terms of the documentation point, would you say actually documentation is somewhat heavier considering diligence than it would be otherwise if you were just considering tax authority kind of views on the business? Do you think there's a need to go further on documentation to make sure that you've got that smooth transaction process when you get there?
Yeah, so I always say, and this is a slightly strange statement, right? So I look after, let's say, 300 Series A, like post Series A businesses, 400 post Series A businesses. Now I know that every single one of my clients in the portfolio that sits across THG is going to be inquired into, right? Fact. But I know they're not going to get inquired into from HMRC, right? That's the lowest level of bar, right? Because they have to find an issue, inquire into it, and ask specific questions. So HMRC is almost the lowest bar. I expect the auditors to ask some questions, being the next level up, to determine certain things. So like, for example, the internationalization, the transfer pricing policy, what documentation do you have in place? They will start to look into those areas. But I'll say it again, all of my clients are inquired into because all of my clients are going through fundraise or liquidity events. So all of them are going to be diligenced at any given point. So yeah, documentation, specifically post-Series B, is really fundamental. But also it creates the health check that you need. Creating that data room and having the right documentation in place gives the potential acquirer or the investor the comfort that you're starting to take like strategic steps in terms of scaling the business.
I think we're useful if we can jump into a few kind of examples of where you may have dealt with some of those things during the scaling phase in a recent kind of scale up client example or something like that. Maybe Series B, C stage would be useful.
Yeah, of course. So I've kind of gone down a route of kind of talking about international. I think I've seen enough instances where, let's start with international. I'll cover some other areas as well. So international is unfortunately one of those areas that kind of doesn't necessarily, or it does get overlooked at times. I think most people will understand kind of like the fact that they will create subsidiaries, but then there can be, especially at Series B and beyond, there can be issues and tensions where transfer pricing hasn't been well considered and thought through as well as it should be. We may be inadvertently creating what's referred to as permanent establishment risk as well. So I've seen quite a few instances where we are inadvertently creating taxable presence in multi-jurisdiction and then not having an awareness of that, right? Now, depending on the scale of that, can create a lot of tension. So one of the examples are always, you know, that we saw as the company was gearing up for a transaction was they allowed a complete relaxation of working practice, right? So we were kind of gearing up for a Series C at the point. And basically, it was the people team decided to allow anyone to basically go and work pretty much wherever they wanted to go and work, right? So it doesn't have to be in the UK anymore. And as a result, there were 300, 400 people working in the organization, something like 80 or 90 of them then decided, actually, we're going to leave the UK, we're going to go and set up whatever we like, okay? Without any consideration. So the head of finance, CFO, phones me and they're like, just heard from the head of people that we're basically allowing anyone to go and work wherever we like. And so they had pockets of individuals who basically were sitting up shop pretty much across wherever they wanted. And the question that was posed to me is this going to create a permanent establishment risk? Now, some instances were going to create PE risks in country and others weren't. But also, it just gave a complete, it was a massive minefield in terms of like the governance that was required, how you would set that up and all those other areas. And so the concern that we had was, do we need to create local entities or branches? How do we distribute or apportion profit across those? Do we want the hassle of having to do that? Just to be clear, if you've got a few people in a few countries, it's going to be a risk, but it's not going to be a deal breaker. When you've got loads of people who've not really thought about it, or if you're using EORs but not considered the kind of wider direct taxes that's creating, that can create tensions and issues. While we're on international, I'll touch on tax residency. It's such a simple concept. It's where a company is primarily taxable. Now, I raise this because I'm supporting a business at the moment that's just raised a kind of Series E and starting to think about liquidity events and what that might look like. And they've given no consideration around the tax residency. So tax residency is fundamentally, it's a UK concept around central management and control, which determines primary taxing rights, where a board meeting is fundamentally undertaken. Now, this group has something like 20 overseas subsidiaries and not really given any thought in terms of the tax residency required. So they only have centralized board meetings. So there is an argument that once you start to look in the double taxation treaties, actually, it's not clear who has primary taxing rights by virtue of central management and control. Now, the issue this creates is a number. Like, you then have to kind of work out, well, hang on, let's take the US as an example. The US don't have the concept of central management and control. It's purely based on incorporation. So HMRC could well argue that the US entity is primarily taxed in the US entity is primarily taxed in the UK, but we don't want that. Now, if we look at the double taxation treaty, unfortunately, there's no tiebreaker clause, and therefore you have to go to something called mutual agreed procedures or MAPs. Now, that takes a long time to resolve, and there is double tax required when you're working that through without a credit offset. In addition, if it does transpire that it was UK tax resident and you want it based back in the US, you get an exit on migration charge as well. So this is something that's overlooked very easily. It is a very simple concept in premise, but if it's not well considered, it can have a huge impact in terms of exit and migration charges. The same is true for kind of IP or what I'll refer to as contract transfers as well, where we're moving contracts. So as we're scaling operations, we're dropping down and we're having, instead of a centralized billing function or a centralized function, we're moving into local contracting. Now, what I mean by that is you may start to operate out of the US entity, sales will come out of the US entity as an example. Now, one of the key areas that we've got to be careful about is that we don't just move contracts from the UK down into the US. Again, that can trigger exit migration charges because let's say a revenue contract is akin to, I don't know, an intangible fixed asset, a right to future revenue, and HMRC will see that and say, well, look, that revenue was coming to the UK and you've moved it to the US, so the IRS now have primary taxing rights over it. We want to therefore take a tax charge over that. So we've got to be careful about moving any contracts, similarly moving any IP across. I'll always remember one of the deals that I worked on when we were basically selling a company to a US acquirer. There was a piece of IP and the US diligencer turned around and said, well, I'm ascribing a 20 million value to that piece of IP. And it's on you to basically argue to the contrary. And so as you can imagine, that evening I got a call from the CEO who wasn't a particularly happy bunny, saying, well, why has this happened? Why is it 20 million? I said, we just picked a number out of the air, and he thinks that's the situation we're in. And
you need to prove otherwise. And then you need to prove otherwise. Yeah.
Yeah, and prove otherwise. And it wasn't necessarily that hard to prove. But again, it's back to that point. You don't want to be dealing with this stuff like during a diligence process. You want to have all your documentation in place. For that instance, it was really simple. Go and get a valuation at the time, make sure that it was clear. And they hadn't done that. So there was a risk there. I think there's other things. I'm going to come on to share options later when we talk about exit, because I think that's possibly one of the worst things that I've ever seen. And I'm going to talk about tax and emotions. Not something that generally comes up in a sentence at the same time, but it is a really emotional thing. And unfortunately, there will be tears over breakfast if we get our share options wrong. Other areas that have gone wrong in the past, like having good governance in place. Unfortunately, I've seen deals go south because of poor governance. Yeah, they're probably slightly earlier, but we've had like instances where we've identified fraud across the board, or behavioural issues as well. Certain individuals behaving in certain ways, and it just makes it unattractive to a potential acquirer. The deal will drop if there is potential reputational damage attaching to the acquiring entity. And I've seen many instances where there is too much of a risk in terms of acquiring the business. So again, back to that simple premise. Your job as a CFO is to basically make that company as clean as possible and de-risk as much as possible, right? And I accept you can't always do that. But what you want to do is remove the key risks that would be a red flag, and either be a deal breaker or something that stops someone in their wake and say, actually, I don't know if I can proceed with this deal.
Yeah. And it's easy in loss-making high growth companies where paying no tax to not necessarily have a fully baked tax agenda. But yeah, the message there is clearly there needs to be a tax agenda for the group and the growth plan, and make sure that's documented properly through that phase.
Well, unfortunately, so yes, accepting of your fact completely that a UK loss-making business carries no risk is it doesn't wash, right? So there are so many other areas where there is contention around that, and unfortunately, yeah, that's not going to wash.
Yeah,
post Series B.
Yeah. Okay. Thanks for that. So that was a bit of a deep dive on I think tax in that scaling phase. Just moving into Simon, who as you mentioned at the start, looks after FDD and financial diligence exercises, both on either side of a transaction. So whilst Simon, you're normally involved more at the back end in terms of the exit window, you probably, I'm sure, have seen things in the exit scenarios that companies should have dealt with earlier in that scaling phase. It'd just be useful to get your perspective on that, where you think people could have dealt with things much earlier in a process or in that scaling phase.
Yeah, absolutely. Thanks. So I think maybe just stepping out of the sort of our technical detail world as well, I think a really important thing, the key message is never too early to start thinking about this. And, we would suggest, if you're even 2 years away from any sort of exit or liquidity event, this should be on your agenda, probably near the top of your agenda as a CFO. And I think there are lots of technical things, but also the slightly softer things around making sure that you're sort of ready. You've started to lay the groundwork. You started to raise the profile of the business. So we've seen a couple which have gone well, where the business has, 5 years in advance started to think about building visibility, publishing growth updates, a lot of activity on social media to start raising awareness, and also engaging with bankers, investment bankers as early as possible, not through the lens of doing a deal, but just building these relationships, because, for better or worse, investment bankers are hugely helpful in terms of connections in the market and the ability to raise profile as well. So I think there's that bit outside of the sort of, it's almost like marketing, and that's a really important part which you shouldn't neglect. I think then the other thing to be thinking about early is what the value proposition is, and that covers a multitude of areas. But for example, Um, Depending who you're trying to sell to is the first thing. What's your buyer universe? Who are you aiming at here? And is it going to be a multiple different types of avenues? Are you going wide into like trade, private equity, potentially IPO, whatever? Or are you more focused on one of those? They have slightly different requirements. There's also the bit around, is the business consistently ready for sale, in terms of, can you look back over the last 3 years and have a smooth track record that shows growth, depending if it is 3 years.
Yeah.
Start to think about that now. Are there things like sustainable earnings, sticky earnings, things like that which you can point to? Are there potential synergies you can think of depending on the buyer you're going to? What's your cash conversion like? What's your cash like? Things like these are really important early stages. So to pull all this together, what we would suggest is, if you are that sort of 2 years to 18 months out, start thinking now about some sort of readiness assessment. And this doesn't need to be a great big thing, but this can be we do it, others do it, people can do it themselves. But you spend look at each of the key areas, the finance control environment, the accounting matters, the tax structure, the legal structure, and just challenge yourself around, have we got any obvious gaps here? James has raised some points on the tax side, on the financial side. If you're still cash accounting, you need to think about getting onto accruals accounting, and particularly from a revenue deferrals perspective. Have you got any potential adjustments which you could think about, which might improve the EBITDA going forward compared to the historical position? What's the run rate of the business? Those sorts of things. Doing that super quick initial assessment, and we tend to do it in a sort of red flag, traffic light, red, amber, green over various areas, allows you to then flush those out quickly and start to plan an attack of how you either fix them, or at least start to show that you're on a journey for fixing those things. If you can prove and show you're doing something, rather than we just got this hockey stick forecast,
Yeah.
helps hugely.
And in terms of some of the, I guess, the areas in which you've seen support required, if you like, in that prep phase, where have you seen, I guess, management teams or founder teams need that support to prepare in the best way possible?
So I think if you boil it down to a few specifics here, one of the key things we've been doing is around this point around cash accruals accounting. So if you take stepping back a bit, ARR is obviously a critical number in these types of businesses, and often the valuations are linked to that as opposed to EBITDA in these types of businesses. And if you can get it right, obviously you can get a fantastic multiple, and every little helps around this. So I think thinking about first of all having robust numbers. We looked at one recently. You'd be surprised. It's a very big business, but still effectively cash accounting revenues, whereas there was a significant amount of subscription-based revenue. So we went in and helped the management team. It's quite a lean management team. We went in and helped them pre any diligence, so way before any bidder was looking at any of these numbers, to scrub those numbers properly and prepare a proper set of accruals, accounting revenue numbers. That's the first thing. So sort of get the basics right around that, and then you can get into the sort of deal craft around how you present those numbers. And again, we've done quite a bit here around. So you've got your base numbers, but then you can think about, if we take ARR as the example again, there's a number that's your actual number. We've done work with people where you can think about how much contracted ARR could you actually bake in to the number. So, and I think it's very justifiable, where if you've secured work, obviously the actual revenue tends to lag a bit from the work that you've secured. There's a strong argument to say that if you're on a case-by-case basis, if you can justify you've just signed a multi-month deal, you can actually bake that into the current ARR position. Straight away, you've got a significant increase, and you do that by the multiple, away you go. So I think there are things like that to think about. The other key area you should be thinking about, I think, here is around we see it a lot in these types of businesses, how you deal with the R&D costs.
Yeah.
and the capitalization or otherwise of those. And I say R&D again, it's really important, I think, to the devil's in the detail here. Split the R from the D.
Yeah.
Look a lot. Look a lot. Is the D really D, or not? Because it's harder, I think, to justify if it's not. And then getting into some quite granular analysis of what's in that, what projects does it relate to, what people does it relate to. Oftentimes, we find, unfortunately, businesses are not keeping timesheets and things like that, so it's quite hard to work out if it's X% of a person, things like that. But it's
Yeah. Yeah.
important to start thinking about that now, because obviously the more you can justify around this amount is actually improving the business for the future, therefore we can capitalize these costs, and therefore we can actually reverse it out of EBITDA if any is in EBITDA, and present a higher adjusted EBITDA number, things like that.
It's
Can I,
interesting because
can I jump in? Can I
that
jump in here? Because I had a deal fall over, because I didn't talk about R&D before, but I had a deal fall over because of R&D. And it's kind of similar to what Simon was just saying there. So we were doing a diligence and there was a substantial R&D claim, right? And we queried something in relation to it, which was the distinction between SME versus large, which is no longer a thing. But one of the areas that came up was they then wrote to HMRC and said, look, actually, we think we've got it wrong in the past. It was the advisor's fault. By the way, that wasn't us. And we should have been under the large scheme. Now, HMRC then opened up and they started to look at the historical R&D. Now, they went back 2 years to start with, and they were asking questions, but then they opened up 7 years worth of R&D at that point. And they said, actually, on reflection, we've looked at this. We don't think you qualify for R&D. So can you go back and can you tell us like slightly more details around justifying the R&D in a bit more detail? Now, the issue that was faced at this point was there'd been so many movements in the tech team, and they hadn't kept timesheets, and they couldn't accurately demonstrate what work was done. That in the end, when the deal was proceeding, and we had to proceed on that basis, we then said, actually, we have to remove or assume that the R&D claim for the last 7 years is going to be removed in its entirety, right? And let's put 1 million aside for each of those years, so 7 million. So that 7 million became 14 million because we were in a position where we were like, well, look, 40, like there has to be worst case scenario, 100% penalties and interest. So there was a price shift of 14 million on the deal itself, right? And that was enough for that deal not to proceed. So Simon, I totally agree. Like you have to be, and everyone just goes, right, I've got the R&D credit. It means that it's not going to be attacked in the future, but actually it can be attacked, and it can either be attacked by HMRC and removed if they actually look at it in more detail, or because it's relatively subjective, it can be challenged during a diligence.
And Simon, it's an interesting point you made around even being able to go back and calculate it, because we have these situations in audits where a company's looking to shift the policy. Maybe they're moving towards a break-even position, and actually starting to capitalize starts to become more attractive. But can you go back and actually calculate when you change the policy, previous development cost expenditure? If you don't have the supporting evidence, frankly, you're not going to be able to. So even if you're not capitalizing, maintaining evidence of how you would measure development costs is really important, because when you get to that point, normalization and trying to add back development costs, you want to have the evidence to support it in a diligence. So I
think to that point, Steve, you asked about different types of buyers and things as well. It sort of segues into that, because I'm sure people don't, but you shouldn't underestimate how aggressive some potential purchasers can be in terms of the diligence they want to perform here. And to James's point, it's another level compared to perhaps some of the other types of processes you go through. And so I think it's really important to look at it through the eyes of an aggressive purchaser, because they're going to basically start from a position of, we don't believe you. And you've got to prove it. It's not the other way around. And so I think things like that, whether it's timesheets, whether it's specific projects you can link things to, whether it's, a specific team that are just ring-fenced to do this, or all of the above, things like that are super important. And we've seen lots of examples where we've been on, across the table from an aggressive let's just pick a country, US purchaser with a US New York based accounting firm firing questions at us, just as a random example, where you need to be on the front foot there. You need to be able to defend it. You need to be able to show them documentation. You need to be able to talk credibly. You need to be able to. What you don't want is something where you answer the question, they chip away, and then you have to change something or provide
Yeah,
more information, because then the credibility goes. As soon as the credibility starts going, the value starts dropping.
yeah, yeah.
Yeah.
Just on. I mean, obviously, we're touching there, I think, on maybe EBITDA kind of impacting factors. But as you mentioned earlier, revenue is often, in some situations, the driving factor on the multiple on the valuation. ARR seems to be, an opportunity as well as a risk. And you touched on an example there of ways in which you can tweak the ARR. But do you see that being often? Do you see revenue ultimately changing when you get into a process, as in an ARR calculation has been represented during preparation for an exit, and therefore actually you're presenting a different revenue number to the one in which maybe you first saw when you came into the transaction?
Absolutely, yeah. I think that's one of the key things. I mean, it may be just worth pausing around the stage again of where you are in the
Yeah,
process. But if you're in that, we just talked about this exit readiness, and maybe you're 12 months to 6 months away. We're doing a lot of work with people then, what we'd badge as vendor assist. I mean, that covers a multitude of things, but broadly speaking, it is working collaboratively alongside management to help prepare these types of numbers. And the output of that generally can be, again, various things, but generally is a sort of full, robust Excel financial data pack presenting the sales pack of numbers that can be put into a data room and provided to bidders. And of course, the beauty of that is you are on the front foot, in control of the numbers. And we work alongside the company. We'll field questions from bidders, etc., etc., to just provide the bandwidth and the support that's needed. If you look at that again over the 3 or 4 deals, we've done a couple of vendor assists recently. We helped Optimity was sold to Vorbus, which is Optimity IT managed services business, is working on a current one right now, Series A going to Series B. The focus on ARR is super important, because as long as, let's get it absolutely clear, you don't need to present your historical audited or unaudited financial numbers, right? All you need to do is you show those, but then you can absolutely bridge to
yeah,
what you can call the run rate. Let's call
yeah,
it for us sales pack number here.
yeah,
So it's and we've worked on deals where we've increased that ARR together with management through going through this process by I don't know, 20-30%. And again, if you apply a revenue multiple to that, that's a lot. It needs to be robust and justifiable, and you can't take the
yeah,
mick. But absolutely, that's part of our job, to provide that sort of sounding board and challenge. Some examples around that: I mentioned contracted ARR. The
yeah,
other thing is, I think you need to look hard at the types of revenues you've got within there. Some people are badging themselves as ARR. It's not really. And
yeah,
you've got to be careful with that as a first step. Can you actually robustly defend it as an ARR business rather than a sort of recur? Is it properly recurring? Breaking down the revenue into the relevant constituent parts as well. We've had things where we've had to look at things like customers on notice, partial billing, stepped pricing, contingent, that sort of thing. And so the devil's in the detail on some of this. But again, it's to my point earlier, you need to be prepared for robust questioning. So I think we come with really good experience of both doing this on the sell side, but also working lots on the buy side, where we're the aggressive buy side diligence people.
yeah.
And we can bring some of that experience to pull out some of these detailed points and allow sellers to be ready for it.
Could we just talk maybe around vendor diligence and what that looks like? And some
Yeah.
people on the call may have experienced it before, others may not. But particularly in an exit process, generally it's not often used in fundraising in the venture rounds, but in an exit process, we've seen it used very successfully recently. So I think maybe if you could touch a little bit on the concept of VDD, why it's beneficial, and then we can get into some examples as well.
Sure. Yeah, absolutely. So, vendor due diligence. So, again, if we go along our sort of journey on the road to exit, we're probably now 6 months from exit. You'd have got an investment banker lined up helping you support with the overall process. You're now thinking about the actual process of diligence. So this is, we're talking predominantly financial and tax here. There's obviously legal diligence, commercial diligence, technical diligence, etc., etc. So number one, as a CFO, you got an awful lot of plates spinning straight away, and let's not forget you got to do the day job, and you got to focus on the day job and do it really well as well. And actually, one of the pitfalls to avoid, just to throw that in here, is you absolutely don't want to be, as a CFO, taking your eye off the ball of running the business. And what does that actually mean? It means hitting your forecast every single month during this process, because if a bidder sees, particularly in your type of business, any drop off, they're going to challenge it. So there's lots to do. VDD as a concept, if I try and summarize it, is it should help minimize disruption to the CFO and the management team. It should allow you to be on the front foot, controlling the process, controlling the messages, controlling the information flow. It should mitigate risks. It should also maximize potential upsides, which we'll touch on in a minute, and value accretive items. It's not all downside, the work we do. There's positives as well, which in the round should help support, having the most successful deal. VDD is different from vendor assist in that we are actually, whilst we agree what we do and the scope with the seller, our duty of care is actually ultimately to the purchaser. So it is a proper independent report, which obviously gives credibility to the purchaser that if they can rely on it. What does that mean? It means that they won't need to do nearly as much buy-side top-up due diligence. So if you're planning to run a sort of competitive process with multiple bidders, VDD is a bit of a no-brainer, to be honest, because you're basically giving, there will be a full, comprehensive, big report produced with an accounting firm's name on it, which can be placed into a data room, which will have not just the numbers, but narrative, conclusions, recommendations as well. Bidders will therefore be able to rely on that and will do minimal top-up diligence. So you've got one document, you're not having 10 lots of advisors coming asking you all different questions. You're comparing apples with apples as opposed to different bids. So it really helps control and accelerate the process. I guess the other good thing about it is whilst we're not working, we are independent, but again, off the back of, if you've done your sort of exit readiness correctly, this should be a far less intrusive and painful process. We're still going to challenge the numbers, and it still does give management some time before any documents go in front of bidders to think about, is there something I need to do here? Is there something I need to fix here? Again, this messaging point and being on the front foot. If something comes out around the tax risk that might be not fixable in the time, at least you can start thinking about what you can do to start reducing the risk around it. So I think the answer is VDD is more robust, more comprehensive. Let's not forget as well, you can actually convert a vendor assist into a VDD depending on the appropriateness of the situation.
And to be clear, VDD, that point around reliance, buyers can ultimately seek to place formal reliance via contracting with us, right?
Absolutely. So, this should allow them, as I say, to really reduce what they need to do. And also, ultimately, at the end of the day, us or whoever is on risk to the buyer, I think that gives the absolute credibility. If something, heaven forbid, went wrong, they can sue the accounting firm on that. So, absolutely.
I mean, there was a business, technology business in London that we took through exactly this exercise middle of last year. Valuation was probably 100 million, and they went through VDD. Now, one of the points that came up on that transaction, if I remember, was the date of the initial exercise versus then the top-up date. Because once you get 6 months post VDD, you need to do a top up. So being very careful on what date you select the initial exercise to be done versus then the date that you're probably going to have to do a top up, which is going to get more exposure effectively on two sets of numbers. Worth just maybe touching on that, because that can trip people up, particularly if you're not quite performing as expected in that top up phase.
Yeah, that's a good point. I think in any sort of high growth business, potentially, the one you referred to obviously was actually when we started the process was still pre-profitability as well, and it actually hit its first month of positive EBITDA during the process. So that was a great story to tell, right? So there's a whole timing piece around the is the company ready? There's also obviously that macro piece you need to think about. Is the market ready, and are there any sort of headwinds that might set it off? Really important to set. I mean, processes are taking longer these days. There's a whole variety of reasons we probably don't have time to explore now. But a typical process, I think you should be thinking about 9 months minimum these days. It used to be you could get it done in 6 months, not so much these days. And there's more scrutiny, there's more diligence being done. I say diligence across the whole spectrum, not just financial. So when you think about that, the key thing is anchor your date and stick to it. Don't get distracted. We've had one or two where we've anchored it and then guess what? The next month is a super month. But the best thing to do is anchor it, crack on with it, get the work done, and then, if let's say it's a 9-month process, probably at that 6-month point, have a quick trading update done and capture all that good stuff, all that value increase in one go in a 6-month trading update. And that doesn't need to be a hugely detailed exercise. We're doing one right now, actually, which is we're doing in 2 weeks, which is just going to focus on the key upsides around. It's just an addendum report, which is going to be 15-20 pages. It's not regurgitating all the old stuff. It's just incrementally what's happened and crucially what's going to happen in terms of outturn for the rest of the year, forecasts and budgets. We haven't really touched so much. We've talked a lot about historicals. Forecasts and budgets are obviously critical for a number of reasons here as well. Just to be clear, we would be expected in a VDD to cover at least a period of forecasts and give some independent credibility around that. And so, to my point earlier, making sure that the outturn is deliverable and the forecasts are reasonable and challengeable, if that's a word, will be part of this trading update as well.
Yeah, understood. James, can I just come back into you here? I think there's in this exit scenario context, from a tax point of view, I think whilst we talked about risks, there's also opportunities to get to maximize value in that exit scenario. So, maybe worth, if you've got any examples to bring to the table on that, would be useful to hear.
I think if we're looking at things like working capital and other adjustments, then I think looking at the tax profile, if there's been any recognition of any deferred tax, is an area that should be looked at and scrutinized as well. So don't, you said earlier, just because a company is loss making, to what extent is there an exposure? Well, actually, if you've got an abundance of losses, they may act as an asset to you when you're looking at basically selling the business. And to what extent can you place value on those as well? So be aware of those. I would expect them to be challenged, and there will be an argument in relation to that. But those losses have an inherent value attaching to them as well. In the same way that a liability that you might have recognized, a deferred tax liability, again, that might be something that you could say, well, listen, it's never going to crystallize. And as a result, we don't need to take those into account. So there are opportunities that can be pursued. And again, speak to your advisors in relation to how you can maximize those opportunities.
Can we just touch on incentives at this point? Because I think considering management team, founder team, or other people around the senior team, and whether there are opportunities as part of the exit timeline to consider the way in which incentives are structured, pre-deal, maybe also post-deal, but thinking through those opportunities.
You want me to talk about the opportunities, not the risk that options present?
Well, you touched on it earlier. Why don't you touch on the risk as well? Because you mentioned that earlier, but you didn't really quite go into it, and then maybe we can touch on opportunities.
This is the one that I was talking about with the kind of tax and emotions, and it's a horrendous situation, right? look, just to kind of paraphrase what I said earlier, one of the things again that it doesn't get scrutinized until a later stage is really share options, right? And unfortunately, there are too many poorly implemented share plans that we've seen across the years. Partly to do with people doing it themselves, partly to do with, let's be really honest, online automated platforms that don't have enough human interaction, and partly to do with using lawyers that have kind of drafted things that they've used templates for, right? And the reason I can talk so openly about this is because unfortunately I see this go wrong on so many deals that we see. Now, it's emotional, right? For one main reason. Let's assume that what we're doing, and this is very prevalent on an exit, it doesn't bite as hard on a series, on a later series fundraise, but it bites on an exit. So let's take a situation. We've basically put, let's say, an EMI, right, in place for our key individuals within the organization. And we've had it in place for a number of years. And therefore, as a result, the position that we think at exit is those individuals will exercise their share options, their EMI options, and they'll be able to basically take cash out under what's used to be called entrepreneurs or business asset disposal relief, so 10, 14%. Okay. Now, in order to get into EMI, there are a whole plethora of tax loopholes and areas that you need to jump through in order to make sure that it qualifies, right? And I'm not going to cover those now. But unfortunately, it's very easy to pick holes in some of those areas. So, is the company independent? How has the legal wording been drafted? The valuations can be challenged as well. You can look at the number of employees at the point of grant. There is a whole raft of things that could go wrong across these. And unfortunately, they really come to light because if you get it wrong, it can be, instead of it being a capital gains tax, it can be income tax and it can be PAYE, right? And there can be some dire tax consequences as a result, especially if that company is scaled quickly and there's going to be a large exercise amount. So the situation that we've seen, and unfortunately I see it a lot, is where an EMI, unfortunately, was never really an EMI scheme. Okay, it was basically just an unapproved share option plan. And that's because it wasn't kind of implemented correctly or because the valuation just wasn't worth the paper it was written on. And you can challenge a valuation. Yes, you may have a letter back from HMRC saying we agree with the valuation, but if you've not actually disclosed all the information, then you can challenge that and you can challenge it very hard. And again, that can have an income tax issue that arises as well. And by the way, that's really easy to pick apart. You've got the information that's available on Crunchbase. You can look at when the fundraise are. You can look at when the valuation went in. If they didn't disclose it, there's basically a deemed discount. Let me give you the situation unfolds. Sorry, my computer's about to restart for an update. Let's not do that now. Right, so you're in a situation, your EMI doesn't work. You've given your EMI options to your key individuals. You're now having to deliver a message that says you're not going to get under entrepreneurs relief, which is 10, 14%, but it's all going to be subject to income tax at say 40, 45, even up to 50%. Okay, so you've delivered that news. Those individuals are then in a position where they are, basically getting half of what they were expecting to because there's going to be a tax increase in terms of the amount. Why is this massively impactful on an exit? Well, guess what? You're selling the business. You as a founder or as a CFO who's supporting the founder team at this point have basically just agitated all of the key individuals within that organization who have driven the business to this point to a sale. And then the founder team or key shareholders in the business who are then going to roll over are likely to get cash consideration on the deal and then some earnout. Now that earnout will be either over 2, 3, 4 years. Okay. Now that earnout means, in simple terms, you will get further funding if you hit certain milestones based on your business's performance over the next 2, 3, 4 years. Who are those individuals that are going to help you strive and grow that business over the next 2, 3, 4 years? Well, the key individuals that you probably gave the EMIs to in the first instance. So you're in a really challenged position because you've just agitated, and I'm using polite words, individuals who are going to help drive the business forward that then helps you in terms of hitting your targets to get your earnouts over the next few years. Now, if you do that too close and the proximity to a deal, you can't really do anything about it. Because once you've got heads of terms in place, you can't really issue further share options because there's not going to be a big enough delta between the share options that you would issue and the exit that you're going to get. Okay. So in that situation, there are very limited ways of dealing with that situation. You can deal with it post-acquisition with some kind of sweet equity, but is that really going to be a kicker? And unfortunately, where I've seen it happen on more instances than I would like, is where in order to appease the individuals that have been perturbed, again, using polite language, by the issue, you then end up in a position where you pay out grossed out bonuses. Emotion and tax. Not every talk about that.
And in terms of the post-deal considerations on incentives, that often comes up as part of the deal structuring, and we've seen situations where growth shares potentially coming into play. Are there any considerations around that should be planned for, or is that generally just something that gets dealt with live in the transaction window?
No, I would say so. No, I think the key takeaway from this is make sure that those individuals that you want to incentivize prior to a transaction, a sale, are done so with enough time that there can be enough growth in those.
Yeah.
If you haven't, you're going to be able to do anything that's going to move the dial. And then actually what you then want to do is do the deal, and you can't really do anything before it because you're then acquired by someone else, right? Then rebase, reset, and then look at what options might be available post-acquisition and put a structure in place. You don't know what you're going to be, who's going to acquire you. So there's no point even thinking about it beforehand, in my opinion.
Okay, useful. Thank you. Simon, anything else to add on this section? I think we're largely done. If there's any Q&A, drop them in the chat. But otherwise, any other points to add, Simon?
Yeah, just super quickly. I think coming back to my point earlier about forecasts and making sure that you've spent enough time robustly kicking the tires on those yourself, and that those are, they're going to be challenging, I'm sure, but achievable. And this is going to be linked to the whole management incentive plan, making sure that you've got very good lawyers on your side helping draft documentation around this. The devil's in the detail again in terms of the SPA and the incentive agreements. And making sure you have very specific definitions. We've seen things where there's vague definitions of things like EBITDA and things like that in the process. So making sure it's tight, watertight from that perspective, I think is key as well.
Yeah.
Can I have a couple of final takeaway comments?
Sure, James. Yeah.
Sorry, I talk a lot for a tax partner. I think one of the so we've talked about kind of like pre-planning in terms of rolling up to an exit. So we talked about, yes, incentives, making sure you've got sufficient time in place. Think about what you're selling as well, right? Are there elements of the group that you want to carve out beforehand? How do you get those out of the group? Have you got any properties in there that you need to move out? Think about what you're selling. You're selling the whole business. So I'm supporting a business at the moment, and there are basically two tranches of it. But actually, the value lies in separating and delineating those two businesses and selling them as separate as opposed to a composite sale. So do you need to think about how you sell different parts of the business? Do you want to do a bit of a tidy up before you sell the business? Start thinking about rationalization elements of the group, debt rationalizations if you've got debt sitting all over the place, all of these areas. I think you asked me at the beginning, if I was a CFO and I had to start thinking about some of these areas, proactive planning in advance of any event, thinking about where the weaknesses in the group reside, making sure that you've got things buttoned down and data rooms ready to go.
Thanks. Just a question coming in the Q&A. How does the CFO demonstrate her understanding of risks to get ahead of the investor concerns? So might be worth touching on here the sort of risk assessment concept which we run, and also the rolling agenda basis during that scaling phase. But particularly, how do CFOs demonstrate understanding of key risks ahead of investors presenting them?
So, I mean, I think from my perspective, it's around flushing out that there are risks. There's always loads and loads of risks, right? But actually, it's prioritizing what are the actual red flag type risks up front, and because it's the ones that are going to move the needle on value. And actually, a lot of what we call risks probably won't do that. So I think that, the beauty of any sort of early stage assessment is it can focus the mind and allow you to pick, you don't want to boil the ocean here. There's probably a top 10 types. If we come back to our diagnostic, there'll be traffic lights, right? So there'll be a small number of red traffic light items. And so first of all, you want to flush that out. Then it gives you a time and a structure to build a plan around each of those. And the answer is you do need to have a team around. You need to be able to delegate some of this stuff because different people need different skills and experience around here. But I mean, if you take things like what are the typical ones that we find are coming up, it is going to be around the robustness of these key financials and the ability to demonstrate, for example, if you're the things we've spoken about before, but if you take deferred revenue, is deferred revenue supportable as a working capital item as opposed to a debt item, right? That's a key thing that comes up time and time again. And that obviously, if it goes into the debt bucket, it's immediately taken straight off value, whereas working capital is not, because normally you'd just have a normalization. So things like that would be a big financial risk. And you can think about, is it defensible and what can we do to support that? Things like the control environment and the IT and the systems and the reporting, things like that. That's another big thing that comes up, particularly when you go into the private equity world, for example, generally more onerous and quicker reporting requirements. Are you for that? What do you need to do, if anything, to support the team to do that? What have you got in terms of systems? If you're still producing Excel spreadsheets, we need to start thinking about that. That's another big risk. Things like that. This assessment in a few days will help flush that out.
Yeah. And James, on the tax side, in terms of getting ahead of investor concerns on tax agenda?
I think it's working with, just going to be completely candid, working with a tax advisor who understands what the process is going to look like. So someone who may have been a diligencer or is a diligencer, and then can work with you in a friendly capacity to identify where those risks are. And to Simon's point, then you kind of pull together like a risk register. You kind of bucket them down into what I'd refer to as kind of quantifiable material risks, like red flags that make deals fall over, quantifiable immaterial risks, and there'll probably be a large bucket of those, and work out which are the nice to haves versus what can be parked and kicked into the long grass, and what are the theoretical risks. And really having a conversation around how to deal with each of those, bucketing them out, working out, do I need to do it internally as a CFO? Do I need to outsource it? And then working out what you need to do in a sensible time frame.
Just super quickly on that, Steve, we focus there on risks. Let's not forget the upsides. Maybe it's a good point.
Yeah.
As part of this red flag sounds bad. It can cover material upsides that can increase the value as well.
Yeah. I think, key from our perspective is we don't see CFOs need to deal with some of this on their own and be expected to have all the answers. The way we approach things in particular in this team is that we're happy to support people as CFOs as they go through that thinking. So if any of you have got questions on specifics as you're thinking about your own business from this session, then reach out. Happy to have a conversation about it. And we'll also share some sort of summary notes from the call as well. So appreciate everyone attending, and happy to chat if you need it. Reach out to one of us, and we'll see you on the next one.
Thanks so much.
Thanks all.
Bye, guys.